Craig, could you walk us through the key ingredients of a successful tax loss harvesting strategy and share what BX focuses on when designing a tax loss strategy, particularly when integrating alpha?
The evolution of tax loss harvesting really evolved in mainstream U.S. wealth management about 5 or 6 years ago. And what I mean by that is the big custodians and big asset management companies like Schwab, Fidelity, BlackRock, Morningstar created solutions where a financial advisor could go into a portal, select an index like the S&P 500, customize it or whittle it down, and then send it to the execution order management system where some fewer number of stocks would be purchased, less than the 500 that they started with due to the deselection or customization process. The evolution of the industry, one day you just had stocks and then all of a sudden mutual funds were born to give people pooled investments. What was born out of that were separately managed accounts, which essentially were mutual funds, but the stocks were actually in a separate account. And then that, or out of that, were exchange traded funds, where essentially you had the same basket, but it traded on an exchange to give you greater liquidity. And the negatives of all of those were, they just weren't very tax efficient and you couldn't really control the tax outcome. So that's where direct indexing came in and basically said, hey, if you're really interested in capturing losses, you really need to have a separate account that's built with a big basket of stocks that the engine is continually harvesting the losses and replacing those things that they're selling with a placeholder. At BX, we felt there was another evolution, which is this active indexing, which is rather than just starting with pure beta, i.e. the S&P 500, could you have some beta and some active or alpha into your basket, delivering what we call investment alpha plus tax alpha. It's interesting to look at this calendar year where the market had a very strong first quarter, a very weak second quarter, and a very strong third quarter. It's really a perfect environment for tax loss harvesting because so many of the things that investors owned in March and April and May were at losses, because the market had a 15 to 20% pullback. So if you started the year with like one of these, just a tax loss harvesting strategy, you would be capturing a lot of losses this year. But on average, you could expect to earn 3 to 5% in tax losses based on all the studies that we see.
As Craig had mentioned, building baskets with a large number of securities is kind of important for tax loss harvesting because if you own hundreds of stocks, you're going to have losses to harvest kind of along the way. So what we wanted to do was create a globally balanced portfolio, in this case, that each sleeve individually outperformed its own benchmark, and the blend outperforms any sort of global benchmark. And the reason that total alpha is so important is, for example, if you were to compound at 8% for 20 years, you're going to wind up with 4.6 times your money. If you compound at 11% for 20 years, you're going to wind up with 8 times your money. So that's 70% more in your retirement pot or whatever it is that you're saving towards by generating that extra 3%. And we think that that's very doable. In fact, we design our models to try and deliver 3% plus of pure investment alpha. And then you layer on another 150, 200 basis points of tax alpha, you could wind up with 5% outperformance. But even conservatively at 3, you can see what a gigantic kind of difference that makes. So you can see in this portfolio, there's a small cap component, there's a mid cap component, there's several US large cap components, and there's an international large cap component. We built this portfolio purposely the way that we typically do, which is to find outperforming strategies that don't have particularly high correlations to each other to produce great risk-adjusted returns. And in this case, there's 350 names in the total portfolio, which will give clients a really significant opportunity to tax loss harvest along the way. You can see the US harvest portfolio looks very similar, but it obviously doesn't have the international component. But what it has is the Index 1 Mega Cap 50, which is a very good, just pure US beta play, right? So that's giving you, very core exposure. Some of these sleeves are actually exact clones of PSN Top Gun SMAs. It's just that when you ingest them the way that we deliver them, you can tax loss harvest it instead of just handing over that control to a money manager. And you can run it through a vehicle like Alphathena and realize your losses kind of along the way. This portfolio was built with a very different objective in mind, which was to be defensive. And you'll see when we get to the results, this portfolio really would have protected very, very well on the downside.